Hey guys, welcome back to the channel. So, one of the things I want to talk about is when you're investing, how do you want to invest and what are the differences in different types of investing? And the ones I want to talk about today are going to be, I would say the big three, right? Value investing versus growth investing versus just investing in in an index, right? Because when investing in mutual funds, right? You may wonder which kind is the best, right? You know, one of those three. Are you going to do growth, value, or index, right? The main differences between the three are going to include stuff like risk tolerances, strategies, investing goals. But I would say, the most important difference is which ones perform better in a bear market and which ones do better when the economy is uncertain, right? Well, let's talk about that, right? The differences between value, growth, and index funds, right? Well, the first thing to talk about is going to be performance, right? So we're going to talk about how the value stocks are considered to be undervalued and are purchased with the idea that they're going to perform better than expected, right? And then you have the growth stocks, right? They're going to represent companies that have shown, really good, solid earnings and growth, purchased with the idea that they're going to grow at a rate faster than, the overall market or the broad market, right? And then index stock funds, they're going to seek to mimic the price movement of a specific index, right? And an index is a sampling of stocks or bonds that represent like a segment, a sector, or a certain part of the overall financial markets, right? So think of it's called the S&P 500, right? The Standard and Poor's 500. That's an index made up of 500 of the largest U.S. companies by market capitalization. Think of Facebook, Microsoft, Amazon, Coca-Cola, just huge companies, right? And there's a few analysts would argue that value funds often perform better over time than growth funds in uncertain market conditions and economic environments. But growth stocks tend to perform better when markets are trending higher, fueled by consumer confidence. Followers of both camps, value and growth, you know, they strive to achieve the best total returns, right? Neither growth nor value investors can claim an outright victory in past performance history. Index investors can claim that they may not often be the top performer, but they're less often the worst performer during a period, right? They can therefore be confident in receiving at least average returns for a lower average or below average level of market risk due to, diversification and just, low costs. So, these points, they're based on historical performance of value funds, growth funds, and index funds, right? No good investment advisor is going to advise market timing, but the best time to invest in growth stocks is often when times are good during, the latter, right? Mature stages of an economic cycle, during the last several months that often lead up to a recession, but only if you intend to sell before the downturn. So the next thing we're gonna talk about is gonna be volatility, right? The total return of value stocks includes both the capital gain in stock price and the dividends, whereas growth stock investors often rely solely on the capital gain, right, which is the price appreciation, because growth stocks don't often produce dividends. Value investors enjoy a certain degree of dependable appreciation because dividends are fairly reliable. Whereas growth investors are often, they're going to endure more volatility, right? They're going to have more pronounced up and downs of price, right? Value stocks may do well when an economic recovery is in place, but they might cool off if the stock market continues to perform, pretty well. Index stock funds are often grouped into the large blend category of mutual funds because they consist of a blend of both value and growth stocks. An index investor often prefers a passive approach. They don't believe that the research and analysis required for active investing, neither value nor growth independently, will produce better returns that are always higher than that of the simple, low cost index fund. Well, if you're not purchasing for the short term, you may want to buy your funds long before indications of a recession or at the bottom of it, ride it out, and hope for rewards on the reversal. So the next one we want to talk about is going to be your return, right? Because the manager of a value fund establishes the criteria and selects stocks that measure up, right? Such stocks, they're going to be selling at a price that is comparatively low in relation to one of the established criteria. By these criteria, the measures, they may imply a theoretical price higher than the currently traded share price. Earnings data or other fundamental value measures of the stock, let's say debt to equity or price earnings to growth ratio, right? These are commonly used in value criteria. Index investors, they may also believe that the blend of both value and growth attributes can combine for a greater result. The formula might be one half value plus one half growth equals greater diversity and reasonable returns for less effort. Growth tends to lose to both value and index when a bear market is in full swing. The market is trending down. Prices are falling. Index funds don't often rule 1 year performance, but they tend to edge growth and value funds over long periods. Think 10-year time frames or longer, right? When index funds win, they often do so by a narrow margin for large cap stocks, but by a wide margin in mid cap and small cap areas. This is at least somewhat due to the fact that expense ratios are higher, and thus returns are lower for the actively managed funds that are represented by growth and value. This index outperformance for mid cap and small cap segments is also significant because many believe the opposite, that actively managed funds, not index funds, are best for mid cap and small cap stocks. But passive investing, indexes, is going to be best for large cap stocks. Well, okay. What about the bottom line? What's the bottom line? Well, growth funds are comprised of stock from companies that have done well and are expected to keep meeting and exceeding earnings goals. You won't be able to buy them for a bargain, but you can expect solid returns with some volatility. When there's a bear market, don't be surprised to see growth performance go down. Value funds are comprised of stock from companies that are expected to see, some strides in the future, but are relatively low cost when compared to growth stocks. They tend to perform well in uncertain market conditions, but during recessions, they're not so hot. And then since index funds mimic benchmark funds, the returns will depend on whether they are comprised of value stocks, growth stocks, or both. Index funds tend to do better than value and growth stocks in the longer term. Hopefully you guys got some good information out of that, and you can decide which way you would like to, invest if you haven't started already, right? Hopefully, you guys liked the video. If you did, go ahead and hit the like button. If you're not subscribed to the channel, go ahead and subscribe. And until I see you guys in the next video, y'all be safe.